Alright, let me just welcome you in the second entry model video, the continuation. In the previous video, we have been looking for a confirmation around the 71 level, but now we are looking to add some more spice into the picture by looking for continuation entries. We are looking for the continuation, expected continuation on the original higher time frame 4-hour trend, and we are looking to scale in on the way up that will mitigate the zero level of the Fibonacci. So now here's an example, a drawn example, the theory. Here we have a nice bullish structure. Let's just assume that we are moving in a bullish trend. We have a sweep of the previous low and the break of the previous high, meaning there is a Fibonacci pulled from the protected low all the way up to this high point. On the 71 level, we have been already looking for confirmation. Let's just say that price arrived into the 71, swept some liquidity into the deeper region of the 71 right here, swept the low point, broke a high point, and there you just entered in a long setup, entered in a confirmation setup targeting the 1 level. Now, this is the confirmation, but the continuation means that we are looking for extra entries. We are looking to add extra entries after the confirmation tagged us in. So we are looking to stack up those longs all the way up to the zero level. And yeah, maybe sometimes you will get 4 to 5 continuation entries even on one single 4-hour movement. Sometimes you won't have anything. Sometimes price will just simply come down to the 71 level of the 4-hour region and will skyrocket it up to the zero level. Sometimes you will have one entry and that is based on the RNG. You don't know what will happen. You don't know how market will react. You don't know what will happen there if the confirmation is given. You don't know nothing. You are just expecting things to happen. You are expecting that price will react on the 71 and will skyrocket up to the zero level, where you can look for a confirmation and continuation entries all the way up to the zero one. So now let's just take a look at the actual draw movement, that how we are looking to scale in continuation entries. First of all, the cleanest example when price creates the confirmation and you get tagged into the confirmation. Let's just say that here's a sweep, a break, and there is a 71 level where you enter into a long trade targeting this high point. But what happens when price won't tag you in? What happens when price won't tag this first confirmation entry in? Basically nothing, because without that first given confirmation, the continuation entries coming after that will still be valid, but with a lower probability. So first of all, let's just talk about the given confirmation. You're getting tagged into a trade and now you're looking to scale into other positions. Price is moving like this on the 15-minute time frame. The blue arrows are the 15-minute time frame movements, now creating a nice bullish structure all the way up to the zero level. Here you have another sweep of liquidity, wiping out the previous low point and then impulsively breaking another high point. The previous high's structure is broken, meaning since we are still applying the principles and criteria system of the 4-hour entry strategy, we are still looking for a sweep, a break, a volume, which can be found somewhere around here, and an order block. And obviously, if all are fit, we are adding the Fibonacci into the picture, pulling from the protected 50-minute low up to the high point. The same entry criteria system. So we are looking to scale in after having a sweep, a break, and the volume order block. You are looking to scale in right here, meaning you are pulling a Fibonacci from this low point all the way up to this high point, and you are entering on this 71 level. And you're still wondering that what we will do with that 0.5 level, with the premium and discount level. What will we do with the 618 level? 618 level is the liquidity grab, that's the trap level. But what are you going to do with the 0.5 level? That will come into place in the reversal trades, so don't worry, I will explain all these. You don't have to be confused. By the end of this course, this crash course, everything will be explained properly. Now, you are looking to scaling right here, entering on the 71 level, targeting your first partial point on the minus 0.27, and then the final target point will be at the high point right here. This is a continuation entry, which is the best case scenario, because we had a confirmation beforehand right here. Fibonacci from the low to the high, entering on the 71 level, targeting the exact same high point as on the 4-hour one. Now, what is an ideal scenario where price won't tag you in into a confirmation trade here? It won't tag you in, it leaves, and then it creates another continuation. So let's just say that when a confirmation happens and you get tagged into a confirmation, and then after that a continuation forms, that will be the cleanest with the highest trade probability, and that will have the highest trade probability to hit the TP on the 4-hour external high point. But now, without having the actual tagging right here, if a continuation setup forms after the unconfirmed, I mean actually technically confirmed but not tagged in setup, if a continuation setup forms after this, say more right here, sweeps to liquidity, breaks the high point, it is still takeable. You don't have to wait for the original confirmation entry. So let's just say that you have an entry right here, you're pulling this up, and price just suddenly leaves without tagging you in, and comes up to this region where it sweeps the liquidity and breaks the high. Then you're again moving this original entry point up to here. This is the original confirmation entry point. Let me just tell you that you have an option right here, because you still have the confirmation that is unmitigated, but you have another setup where price tagged you, price swept this low point and then broke the high point, and you can pull another Fibonacci from this low up to this high. So you will have two individual setups. Which one to choose? This is a question that no one can answer, even market can answer, because, as I told you, the clean scenario, when you get tagged into the confirmation trade, and after a continuation happens, that's the cleanest, with the highest trade probability. But when price won't tag you into the confirmation trade and forms another continuation with a new entry point, it is not guaranteed that price will react here. It is not guaranteed that you will be tagged into the trade on the 71 level. It is absolutely not guaranteed. You don't know if it will react there. You don't know if it will blast through the stop loss and will go down to the original 71 level. Therefore, you have two options to use right here. First option, the first scenario out of the options, will be to only enter into this trade. Actually, you have three options, sorry. Will be to only enter on the continuation trade, because this still has a probability to play out, but with decreased chance, because this is not the cleanest scenario. This will have decreased chance, but you have an option to enter here, only here, using your full risk and then targeting the exact same high point. Second option is to only enter on the confirmation setup, because the confirmation is still not tagged in, and this can easily become liquidity, but it's not guaranteed that it will become liquidity, because I've backtested countless hours of this entry level, and I've seen happening like in a 50-50 ratio. Sometimes it's sweeping you out, sometimes it's not sweeping you out. So you don't know what will happen here. There are no statistics, proven statistics can be given that, yeah, you can enter on the confirmation only because that is going to happen for sure. No. Sometimes you will miss a setup on the confirmation. Sometimes you will lose one on the continuation. You don't know. But the second option is that you can enter on the 71 of the original confirmation only. And the third option, which in my opinion, my humble opinion, is the best one, is to pull the Fibonacci from the original confirmation, pull the Fibonacci from the continuation, and you split the risk in between the two setups. You enter here with half risk, and you set a limit here with half risk. In case of the continuation sweeps you out and the confirmation tags you in, you will still make a pretty nice amount of risk-reward ratio and percentage profit on this movement to the high point. So this is the third option that you can choose, and in my humble opinion, this is the best option to have. Because in case of you're getting swept out from both of these setups, you are losing the original risk amount, right? Because you would have risked 1%, for example, here on the continuation setup, and you are not risking nothing on the original confirmation. If it sweeps you out, you're losing 1%. If you are splitting the risk, you are using 0.5% on the continuation, 0.5% on the confirmation. And then, if it sweeps you out, you will only lose -1%, just like if you would have used the full risk here. If you are only using 1% here on the confirmation, if it sweeps you out, you will lose 1% as well. But if it tags you in on the continuation and it goes to TP, you will make a really nice risk-reward ratio return with that half risk. And once again, if you place double limits, risk split here and here, in case of this sweeping you out, you will take -0.5% there. You will only lose 0.5%, right? But if it tags you in, it will compensate for the loss and will make much more. So once again, in my humble opinion, the best is to split the risk in these options. So now let's just talk about what happens when price continues after this overall movement. And I want to highlight one more important scenario, that when price breaks the structure to the upside here, have a low point, but this low point is not protected. Basically, price will be inside of external range on the 15-minute time frame. Here, inside of the 15-minute low and high point, price creates a 15-minute pullback. And in this pullback, price sweeps out the low point and breaks the internal high inside of the external one. In this case, what can we do? In this case, what you can do, or what we can do, is to take this as a sweep, take this as the break, the internal break, internal sweep, and then you can pull the Fibonacci from this high, from this low to this high point, and you can still enter on the 71 level right here, because basically this is the confirmation of the external overall setup. So right here is the external setup, high, low, break the structure, coming back down, and then confirming it with a liquidity sweep. And this is takeable by only having an internal sweep and an internal break. But important note is that the probability of this setup will be decreased. So once again, this is not the highest probability setup, but it's still takeable and still has a really decent chance to hit the TP and to serve you with profit. The actual meaning and purpose of these continuation entries is to try to scale in. Try means losing. Try means winning. Sometimes losing, sometimes winning. You have to outweigh your losses by winning more in risk to reward ratio. And by having this really nice amount of risk to reward ratio TPs, like I told you, from 5 to 15 risk to reward ratio can be gained from the confirmation and continuation setups, you can easily outweigh those losses with the wins. So you can have like a 20 to 40% win rate and still be extremely profitable. So once again, this model is not for those who can get used to losses. If you can get used to losses, then this model is for you, because I promise you that you won't have a high win rate. You won't have an 80% win rate. You won't have a 70, 60% win rate like in the higher time frame model. No, this will have a lower win rate, but the whole idea is to outweigh your losses by the wins. And this will be done by the risk to reward ratio and not by the win rate. So this is the idea right here. And one less important thing, that what happens if price breaks the high point. Right here, the 4-hour external high point is broken. And for example, on this break, there is another setup where price sweeps out the low point here and breaks the high point, and not just this high point, but the 4-hour high point as well. In this case, there will still be an entry. So you can pull the Fibonacci from this protected low point down here to the high point. You can pull that Fibonacci, but the chance of price hitting the TP is significantly decreased because price completed the 4-hour movement. The 4-hour external high has been reached and has been broken. And once it's broken, what we can expect is a pullback, because this is how the 4-hour structure moves. This is just the internal 50-minute structure of the 4-hour overall swing or external structure. So once this is broken, but there is a setup, it is takeable, but just know that it has the lowest win rate, like 20 to 30 to 35% win rate. Still, if you execute everything that lines up on your screen, that is right according to the trading plan, fulfills all the criteria system, then in this case, the wins will outweigh the losses. So you will still end up on the profitable side. But I'm just telling you that this has the lowest percent win rate out of them all. The highest percent win rate is when price confirms you into a setup, into a first confirmation, and that it forms a continuation. In this case, this is the highest win rate setup. And now, let's just end this video here and take a look at live examples in the next one.